To unlock the potential of your property, you need a partner who can foresee future trends, help you innovate to stay ahead of the curve, and build your competitive advantage. We see the opportunities that will help you achieve your goals faster. Because success isn't just about keeping up, it's about leading the way. Our experts deliver fast, flexible, and tailored solutions to realize your goals at all stages of your strategy, blending proven expertise with data-backed insights. We're here to accelerate your success. Let's lead the way together.
Good afternoon, everyone. It's my pleasure to welcome all of you to Colliers second quarter 2024 Philippine Property Market Briefing. Once again, I'm Maricris Hoson, Director and Head of Office Services Landlord Representation. I will be your host and moderator in today's discussion. I know everyone is excited to know how the sector performed in the second quarter of this year. I'm sure all of you have a lot of questions, especially given the news that shook the industry. In recent days, I myself have received so many inquiries from landlords, occupiers, and other stakeholders. So in the next hour and so, we at Colliers will do our best to provide you insights and recommendations, and perhaps some assurance that will guide us in navigating the rest of 2024. But before we do that, let's first acknowledge our official event partner for this event, the Ascott Bonifacio Global City. We would also like to acknowledge the following partners who made this event possible: ABS-CBN News Channel, Inquirer Property, the Philippine Star, Business World, the British Chamber of Commerce of the Philippines, Australia-New Zealand Chamber of Commerce of the Philippines, Subdivision and Housing Developers Association of the Philippines, Organization of Socialized Housing Developers of the Philippines, Department of Human Settlements and Urban Development. At the end of this session, we would also like to invite you to stay a bit longer for our networking opportunity. Our team will be here to answer any of your questions you might have about Collier services, which include occupier services, landlord representation, capital market and investment services, valuation services, advisory and consultancy, project management, and real estate management services. And just now, we have released our Q2 2024 reports covering the office, residential, hotel, and industrial sector. Please do not forget to download copies of this report via the QR code scattered around this venue. So with that, let's begin our briefing. It's an overall rosy picture of the Philippine economy in 2024. GDP grew 5.7% in the first quarter of 2024, although lower than most analysts' projections of 5.9%. The economy grew at a fast pace compared to the previous 3-month period. According to the Asian Development Bank, a proactive reform agenda of the present administration is making the country a more attractive investment destination. These reforms include the lifting of restrictions of foreign participation in certain industries such as renewable energy, telecommunications, airport shipping, railways, and expressways, resulting in foreign capital flowing into the sectors. As all of you might already know, President Marcos announced the government's intention to ban POGO firms in the country. And our office services team have initiated an interesting conversation on how this issue might affect the office sector. Today, we will dig deeper into this issue. The residential segment, on the other hand, might be experiencing moderate demand as of late, but there are bright spots in the sector, namely horizontal housing, leisure-oriented communities. Our head of research, Joey Roy Bondoc, will look into the drivers that will spur the residential sector's recovery. Joey will also discuss the performance of both the hotel and industrial sectors in the previous 6 months. We'll be hearing from him exciting updates, including all-time high completion of hotel properties and foreign brands betting big on the Philippines tourism, and for the industrial segment, sustained demand for cold storage facilities and industrial parks with integrated communities. So despite headwinds, things are definitely looking up. Will 2024 finally be the it year? The one we will all remember as the year the Philippines property sector finally turned a corner. To discuss the office sector, let's welcome Colliers Director of Office Services Tenant Representation, Kevin Hara.
Of course, call on my colleague Maricris to also introduce other members of the panel for our Q&A.
Very good, Joey. All of us are updated with the residential, hotel, industrial sector. I'm sure a lot of you have questions. My colleagues, Danes and Charles, are in the left and right side. So please do write your questions. And I'd like to call my colleagues to help us with answering these questions. First, our Colliers Managing Director, Richard Romulo, Head of Capital Markets and Investments, Julius Guevara, Head of Advisory, Tim Teodoro, and Head of Valuation Services, Paul Ramirez. Okay, so Danes, I think, has a question from the side of the room. Go ahead, Danes.
Hello, good afternoon. Go ahead, sir.
Good afternoon. Vic Manarang here.
Sorry, Kevin. Kevin.
I'm tired of being the pessimist of the last several years, and the bad outlook has already come to fruition, and we're here in our current market environment. So I want to turn positive. The industrial sector in various economic fora that have been taking place recently seems to have focused towards data center expansions globally, actually, outside the Philippines. Presumably, there are opportunities for that in the country, and so what features of those opportunities might we be seeing today, and what are the challenges for doing that, as we should be able to capitalize on the benefits of the Philippines growing, very big right now, and still growing internet usage and involvement by the population.
Yeah, I'll take that question. So thanks for that question. The demand for data centers is really massive, because of digital transformation. We've seen that during the pandemic. However, if it's quite challenging to build one just because of the cost. If you're wearing your real estate hat, it's not going to work, because on a per square meter basis, it's approaching 1 million pesos per square meter, right? And there's several factors that affect the location. Most of the time, if you're a real estate developer and you look into that potential sector, you'd say, I have a lot of extra space that I could build a data center on, and I could utilize it. But barring the cost, there are a lot of factors that affect it, mainly power. The OPEX for data centers, like 50% power. So you need to have a stable supply as well as a cheap supply for it. Having said that, there's a lot of opportunity, but if you take a look at the first movers, there's still it's still not a stabilized market. And if you take a look at the first movers, they're still trying to ramp up their actual utilization rate. So if you're the likes of PLDT, Globe, Converge, it might be easier because of the vertical integration towards the related industries. But if you're like an early entrant, it might be harder. And of course, you need to have a data center operator partner who will actually bring in the hyperscalers, because there are only a handful of hyperscalers that actually have the accounts there. They're appointed by the likes of Alibaba, Amazon, etc. And they have those accounts. So they have to convince these clients to actually come into the Philippines and operate. So it's really, it's not that simple. It's not just having land, because the cost is really exorbitant to put one up. It's very challenging.
Okay, so for the questions that was emailed to us, the first question is, how long will it take for the market to digest the current build-up in residential inventory? Is there any historical trend between the start of rate cuts and an acceleration in residential take-up?
I think you saw that in the slides a while ago. Joey, what's your take-up? Is that 3.5? Years?
For almost 5 years, sir,
Almost
right now.
5
yes.
years. Okay.
Nearing the 5.4 in 2021.
Okay, so that's the hard fact is if you look at the current take-up rate for the 70,000 units right now in the market, it's good for 5 years. But then, of course, that is based on that average take-up that we have right now. If the rates get cut and that helps, then of course your take-up will improve and hopefully that average goes down because it will just move with that. But the reality is it's the residential market right now. So you have 70,000 units that is unsold in the market right now. So it's no surprise that there's no new launches in condos. You have, Joey, what's your quantification for how much is that? Is that more than 100 billion
113, sir.
billion
Yeah,
pesos
30.
worth of inventory in the market right now? And out of that 70,000 units, you have 20,000 RFO. That's now ready for occupancy. That does not include what Joey was saying also, that if POGOs leave, you're going to have a higher vacancy rate, particularly in the Bay Area, which can go from around 25% to 55% in that scenario in the Bay Area. So this is why there's not much new supply coming in, and the new projects are in the house and lot and lots outside of Metro Manila. That's really the reason why we were that's the quantification for all of that.
Okay, thank you, Richard. This is for my office leasing colleagues, Marie-Chris and Kevin. What's your take on the office space demand in Binondo and Asiana areas?
So I'll take the first question. So we have a property in Binondo. It's by Philinvest Columna. We also handle the Cobon Cat building in Binondo. So most of the inquiries we're having there are traditional offices in the Manila area doing a flight to value, or those buildings that have no parking and they want to move to a building with parking. Mostly traditional companies are the occupiers looking at Binondo. And for Asiana, we've closed a number of logistics companies in the Asiana. Kevin?
Yeah, the Bay Area remains to be the top market, the fastest moving market in terms of office space, driven by traditional occupiers, including government agencies, as I mentioned in the report. There are also some POGO deals, but on average, they only constitute about less than 20% of the deals that happen overall in Metro Manila. So that's the same for the Bay Areas.
Joey from Vic Manarang, which sectors are expected to benefit from interest rate cuts this year and next year? How much impact will it have on demand and cost?
I think across all segments, so we can, for example, first specify office segments. So you have lower interest rates that will likely entice a lot of office occupants to expand operations. And despite the implementation of work from home, some of them still occupying office space. So they're likely to also expand their office footprint. But looking at interest rate cut, of course, residential sector. Again, similar to my slide earlier, if we see further interest rate cuts, that will also result in the dropping of mortgage rates, and that will likely stoke demand in the pre-selling sector, especially in Metro Manila, which remains lukewarm at this point. But lower interest rates also will probably entice more tourists, especially local domestic tourists, and that will also help influence take up occupancies of hotels across the Philippines. Also, I highlighted industrial locators. So if you have these local manufacturers and they see interest rate being cut by the central bank, they're likely to expand operations, and they're also likely to expand industrial space that they occupy and even take up more warehouses.
And a lot of news about the luxury and ultra luxury market, Joey. What's the outlook of this sector?
Well, that is Richard's segment, so I'm going to pass that over to Richard. The luxury.
Well, you saw the slide that you presented a while ago now. Of all the segments in the residential market, the one that's moving is really the luxury. Why they're not really affected by the interest rates, and they're not looking at yields. I was talking to Vic a while ago, Manarang, and we were talking about negative carries and positive carries. In the Philippines, the yield that you're going to get in residential right now with your interest rate with mortgage is negative. You go to a bank, what's your mortgage rate? 7, some are 8, 9. What's your yield on a condo right now? You'll be lucky at 4, 5. You'll be lucky. That's the problem, right? But the people who buy those ultra luxury, they don't look at that carry. They probably would look at capital appreciation. I'm going to hold on to this. They're going to look at prestige. They're going to look at a trophy asset. Hence, all of the developments that you're seeing being launched right now are mostly trophy assets, right? No one's really looking at yields right now. It's a capital appreciation play. So that part of the market is doing very well. The one wherein most of the inventory is, as Joey showed, is on the affordable up to the mid-income, up to a little bit on the upper mid. And it's a wide segment. That's a huge segment of the market, and hence, no one is launching because there's so much supply in the market right now. There's that 70,000 units out in the market, wherein that luxury segment is so small. It basically, Balmori of Rockwell has sold off quickly at those prices. But the ones which are selling at that 5 million pesos, less than 10 million, are still having a hard time moving their inventory. And that's the result.
Thanks, Richard. Questions from Mega Dornis of Philippine Daily Inquirer. So these are for Kevin, Tim, and Julius. I'll start with Kevin. Will office vacancies improve, go down this year? What factors do you think will affect the office vacancy? And then for Tim, when will high demand for middle, upper mid-income segments in the residential market return to pre-pandemic level? For Julius, are you seeing more investments in the hospitality sector, those acquiring perhaps older hotels and redeveloping them? So due to the revenge travelers, so Kevin, Tim, and Julius.
Okay, so we had a slide on that, no? We did a sensitivity analysis on vacancy forecast, worst case, best case. Right now we're at 18%. And assuming there's no POGO, actually that's going to creep up to 19%. But assuming all the POGO players and their leases, they exit the market in full force by end of the year, we're seeing a maximum of 22% vacancy rate for Manila. If just a partial exit, still seeing 20%. So we're up there at 20%. We're there already. Next year, we see that will taper already. Quite by the end of next year, no, to I don't have the figures really, but it will taper to down to 19 again and down to as much as 18 by 2026. The reason for our demand forecast, that's why we remain confident, is that really, we've been saying all along, it's really the traditional office space occupiers and the BPOs that are driving the market, not the POGOs. So if you consider our transactions activity from this year compared to the same period last year, so actually we're 50% up. We don't have a slide earlier on this, but if you consider vacated spaces from the number last year, we're down 30%. So, these factors come into play, and we see that there will be a sustained demand in our traditional office occupiers and BPO occupiers. Of course, there's the election, but as I mentioned in the previous report, the US election does have a temporary effect on the office market, but it usually recovers quite quickly in the succeeding quarter after the elections.
Kevin, I think it's also important to qualify the locations. Because while you're going to have an increase in your vacancy rates if the POGOs exit, there are certain locations which are more affected than others. Like if you look at Makati and Fort Bonifacio, wherein there's very little POGOs anyway, and your vacancy is starting to inch down to single-digit levels, actually, there are certain locations that are okay. Of course, the obvious one is the Bay Area, like the residential, which will have that huge impact on the vacancy.
Yeah, correct. So for Bay Area, for worst case, it will go to same as residential 50%. And in some areas in Makati, not the CBD, but fringes of Makati, that market will go to a maximum 40%. And it's just those two areas, really. You know, it's a good thing that, you know, POGOs need LGU approval before they can even operate in a certain location. And it somehow protected the overall office market. The regulation or the policy that you need a letter of no objection from City Hall before you can operate. In hindsight, it really actually worked and protected the general office market. And now we're seeing the POGOs really just concentrated in certain locations and not in the entire market in Manila.
For the residential sector, the question was when the affordable mid-income market will start to recover. For the middle-income affordable condominium market in Metro Manila, it's usually composed of end user and the investor market. The end user market is always been there, no? The difference lang is there's some transfer already to the areas outside Metro Manila where they get better value for money. For the same TCP, they can get bigger areas since there's better connectivity already from Metro Manila to all of these provinces with the different infrastructure projects. It's also convenient already for them to live there. So we've seen a shift of the end user buyers moving out of Metro Manila. And it's also interesting that the house and lot developments outside have started to offer longer payment terms. So even 36 months when it used to be 12, 18 to at most 2 years. So it makes sense for a lot of the end user buyers to go outside Metro Manila when buying their houses. For the investor market, that's where, of course, it's all dependent on how they see the potential of the locations are. And as you can see, the office market is still in recovery stages. General economy is also still recovery. We've talked about the yields from residential projects not making sense right now, and so until those metrics improve, then we see a more tempered demand for the investor market.
And then the question was about hotel
The acquisition of hotels here by foreign brands. Are we
Okay,
seeing
so there are a few foreign funds who are looking for opportunities to buy hotels. What I've seen earlier this year was that your typical hotel brands who would just typically do a management contract, they're now actually willing to put in money into the hotel developments. That's something that I've never seen before or lately. And I think there's still some opportunities in the hotel space. I actually toured one of the 5-star hotels here in Makati about 4 weeks ago, and the GM said that they're doing very well, upwards of 80%. So the market in general is doing quite well, but I think it's also locational. As was pointed out earlier, Quezon City is not doing that well. I think it's mainly because of a major economic driver. ABS-CBN is no longer around to really drive demand in that area. So it's really locational. Spoke to one investor recently who pointed out a very important, observation that in the secondary cities in the Philippines are no good businessman's hotels, so mga 3-star hotels. It's someone that like a salesman who would be traveling in these cities would want to stay in a quality hotel with a good bed a good mattress. So it was a very good observation. So I think there are opportunities in those kinds of cities that don't typically have a good hotel stock.
Okay, thank you, Julius. For Paul, there's no escaping the Q&A. We saved the best for last. Any proposed input for the implementing rules and regulations of RP Vara?
Hirap naman. So basically, what's the important thing about RP Vara is the positives, because number one, they will open up the real estate transaction database of the registry of deeds. And what will that do? What will that do? It will enable us to see the property market as more transparent. So we'll see what the actual transactions are happening, and with that as well, the updated values, schedule of market values, will also be in line with the actual market values. So the effect of that will be, of course, higher transaction friction costs when it comes to property transactions, and maybe possibly a higher real estate property tax, the one that's being netted by the local government. So one of the positives that I see really is the making the property market more transparent. Everybody will know what's the transaction that's happening around, and if everybody knows, then everybody will have a very good idea as to the values of their asset, which is, in the Philippines, our home is actually our number one asset, and knowing that value really will help us unlock those properties.
Thank you, Paul. Thank you to our Colliers experts, headed by Richard Raimundo, Tim Teodoro, Julius Guevara, Paul Ramirez, Kevin Hara, and of course, Joey Roy Bondoc, for always shedding light on the current landscape of the real estate sector and providing us with useful insights and recommendations as we face very promising months ahead. We would like to once again thank our official venue, the Ascott BGC, our event partners, the ABS-CBN News Channel, Inquirer Property, Philippine Star, Business World, British Chamber of Commerce of the Philippines, Australia New Zealand Chamber of Commerce Philippines, Subdivision and Housing Developers Association of the Philippines, Organization of Socialized Housing Developers of the Philippines, Department of Human Settlements and Urban Development. And to officially close our program, let's hear our final remarks from our Managing Director, Mr. Richard Raimundo.
Okay, so thank you everyone for coming over for our quarterly update. So it may seem that if you look at the numbers right now, there's so much items of concern. But what we present to the market right now is to give you a deep dive into what's happening into each sector. And, example for office, while yes, the POGOs could leave and that would increase the vacancy rate, but if you look at certain areas, it's actually pretty good. There are locations which are faring better than those which are affected by the POGOs. Same for residential. While we have about 70,000 units, 20,000 of that ready for occupancy, there are segments which are doing very well, and there are locations outside of Metro Manila in the mid-income market, which continues to perform well in terms of take-up. So again, we hope that we were able to give you the insights, the knowledge into the different sectors. And if you do need more information, please reach out to us. We'd be happy to discuss with you the market. Again, thank you very much, and hope to see you again next quarter. Thank you.
Thank you, Richard, and thank you to everyone who joined us today. You're welcome to reach out to our team if you have further questions, would like to receive more information on the office, residential, hotel, and industrial sectors. If you'd like to stay updated on the latest news and insights in the Philippine property sector, please visit our website, colliers.com. Follow us on LinkedIn, Facebook, Twitter, and Instagram. Please do hear more from Joey. He regularly contributes articles in the Philippine Daily Inquirer, Philippine Star, and Business World. So if you have new projects, please do share it with us so we can write about it. Thank you all for attending our Q2 2024 Philippine Property Market Briefing, and see you again in October.